Okay, welcome to another weekly run through of the top 5 charts of the week. Now, for those of you who weren't aware, this is a weekly mail out that goes to the newsletter subscribers from the website, and so we've got a sign up link. It's sitting there, but I'll put it into the description of the YouTube video. But anyway, this is just a selection of 5 charts from the blog and social media from the sort of publicly available charts that we do. We've got much more charts that are, part of the research service, but we can talk about that later. So anyway, I'm just going to take you through these charts and add a little bit of extra context and, give a little bit of insight into why I picked them. And we'll get straight into it with number 1, which is US economic confidence. Now, just a little bit of explanation around this chart. So we're looking here at a bunch of different indicators of, economic confidence basically. So we've got the NFIB Small Business Survey, Consumer Confidence, Manufacturing PMI, the NHAB, so the housing market as well. And then a couple of other indicators there as well. And what we do is take a Z-score of those, so standardize them, put them on a comparable basis, and then take a simple average of that. And what you get out of this is sort of a combination of the signal. And I always think that, when you're if you want to increase the chance of getting signal versus noise, then one good way to do that is to combine a couple of series or a couple of signals, and the consensus or the vote, the total vote of each of those signals comes out, with a more, I guess, enhanced or more well-informed conclusion. And for this, it's basically, all signs are pointing to extremely hot economic confidence in America at the moment. And the last time we saw these sort of levels was, in the late 90s and, in the early 2000s as the credit bubble was getting well underway. And so, I guess it's a pretty interesting signal in that respect. You might argue that it's a late cycle signal, and it's certainly indicative of a business cycle that is well progressed. But what if you want to take the glass half empty view on this, and if you're looking for things to get negative about, I would actually be waiting until you see this roll over. So if you think about the financial crisis, this is really quite interesting. You can see that it actually trended down for a number of years before things finally unwound there. And it's certainly something to keep in mind. And this business cycle is steadily maturing. On to a number 2, which is called energy sector equities, and this one's showing you two things for one sector, and this is the S&P 500 energy sector, and we're looking here at in the blue line, the market cap weighting. So it's just, that's pretty straightforward, and the earnings share. So that's basically the same thing, but on earnings instead of market cap. And on both respects, they're very low against average, and I guess the point that I'm kind of trying to raise or allude to there is, what are the prospects of a potential mean reversion for the energy sector weighting? There's a lot more to it. I might leave you to read the article on that one, but I guess there's two main schools of thought. One is that it is just a cyclical low, and as the oil price remains stable or goes higher, these energy companies are going to improve their earnings, efficiencies, etc., and are going to turn around. And then, of course, when you're talking about a weighting, there's always two sides to any coin, and the other side of that coin is that the big heavyweight sectors reduce in size. So if you think about technology, that's grown to be just over a quarter of the index now, and that's seen substantial growth in its weighting. And from a cyclical standpoint, that could be something that would mean revert at some point as well, or at least trend revert. And speaking of trend, that brings you into the other school of thought, which is maybe it's actually a structural thing, and maybe it never will return to that average of 9%, or to the 10% plus levels that we saw during the commodity boom. And those people will be pointing to things like fusion energy, solar, and all the sort of new technology that may change the nature of energy in the future. And then of course, yeah, again, thinking about the other side of the coin, technology, um, you know, technology companies, healthcare companies, these are things that are probably in, a structural uptrend. We're probably only going to be seeing more of that trend overall, but as I always say, you got to be careful when people start wheeling out those structural themes or new paradigms. Structural trends can be very important, but most often, almost always, there's a cycle around that, and I would argue that that's a cycle, a cyclical thing there, perhaps within a structural thing. Anyway, next one, global equity factors. This chart here is showing the average of the relative performance of momentum, low dividend yield, growth versus value, and cyclicals versus defensives. And you can see there that since, I guess, the start of 2017, it really just went parabolic. It just took off. And I guess there's a few things to think about there. Is first of all, we've seen a similar kind of thing happen just before the financial crisis, and maybe there's something in there, maybe there's not. But I guess the other thing is that these have been fairly hot or popular factors like momentum and growth, and whenever you see an extreme in markets, you always want to pay attention. And the habit, the overwhelming habit, tendency of investors is to follow past performance, and you always see those warnings on fund fact sheets that say past performance is not an indication of future performance. But everyone looks at past performance, and it's kind of makes sense. It's kind of rational to want to have a look at some data, and it's it's the next best thing to having future data, right? And so what you get is performance chasing, and it's fairly endemic and predictable, and widespread across geographies, markets, countries. That investors will chase performance, and what that can result in when you get things like this is the performance of momentum, etc. There's the bandwagon effect, so people start loading up and loading up, and that's how you get and feel speculative mania, speculative overshoots. And that's what I would be concerned with in a chart like this, is that it could be the sign of some speculative overshoot that, yes, it could go further, but at some point most likely to unwind. Number 4, sticking with a kind of a pessimistic hue to the analysis at the moment, or the theme of the last one at least. So this is in the red line, the diffusion index, a monthly diffusion index across the 36 countries that the OECD calculates leading indicators for. And you can see that after turning up quite substantially in 2016, it topped out and started to roll over at the end of last year, and then had quite a downtick in January. And the problem with this is that not all of the time, because there's been a few false signals and a few early signals, but you have seen these kind of downturns in this indicator precede a bear market or sizable correction in global equities, and so that's kind of the reason why I highlight that one. The other interesting thing about this chart is that if you look at the pre-2010 period, I guess pre-2010, there's these more pronounced and sharper gyrations in this indicator versus the last, I guess, 5 to 8 years has been it's been much more smaller range, and I guess the popular argument might be that that's just a result of central banks quantitative easing, reducing volatility, but more nuanced view might be that in 2012 the reason for that downturn was the Eurozone crisis, which was mostly concentrated on the Eurozone area rather than emerging markets, etc. per se. And then again, in the 2014-15 downturn there, that was mostly commodity producers and emerging markets in that episode. And I guess that highlights one thing, is that around 2008 we actually saw quite an interesting transition take place where up until that point developed economies had accounted for the dominant share of global GDP. That actually changed in 2008, and emerging markets since then have become and have increased their share of world GDP. I mean, China's obviously a big factor in that, but the others have been steadily growing as well. If you think about even some of the slower growing emerging markets, growing at a pace of 4% versus some of the larger developed economies only growing at 1 to 2 or even 3% in the best case. Kind of a logical progression, and it kind of makes sense, I guess, in that sense that you have a changing dynamic in the global cyclical outlook. So certainly one to keep on the radar, that one. And the final one, I didn't mean to make this a pessimistic, bearish sort of thing, but the last one is also on the negative or pessimistic end, and that is the property price outlook for China. And we've already seen there that the rate of price increase has actually rolled over, but then you look at the red line, which is a composite leading indicator, so that's one that I've just put together myself. That's including things like money supply, interest rates, and relative performance of property stocks. It's each of these various indicators that comprise it have anything from a 4 or 5 month lead to a 12-month lead, and we're seeing there that basically it's pointing to that slowdown continuing. The distinction to make on this chart, or the differentiation between something that would be extremely bearish versus just a mildly disconcerting, would be whether it goes into just a slowdown or a period of slower growth. If you took that chart literally, it would be saying that we're going to have 1% growth for the next 12 months, month after month, and that would be it would mean that it's not going to be growing as fast, that the property sector there is not going to be growing, or the activity levels are not going to be perhaps as much if they were if it was 5% plus growth month after month. But then the bearish view would be that it doesn't go into a slowdown, but it goes into a downturn, which is it's might think it's just a play on semantics, but what I mean by that is it has more of a 2015 style downturn in the market where prices they don't just slow down, but they go negative year on year. Falling prices can introduce an entirely different dynamic. The moment prices start to fall, that starts to impact on consumer confidence. It tends to act as a headwind for the property sector as well. And if you think about properties, the main asset that's supporting a lot of loans there, it has an impact on credit quality and all the rest of that as well. So it's possibly bearish, possibly very bearish, or possibly just a signal of slower, more subdued outlook for there. And look, that is the whole 5 charts, and I've just put there go through that. But yeah, we'll just say if you like what you see here and you don't want to miss out on any future updates, make sure that you subscribe to get this delivered to your email box. The link is there on the screen, but I'll put it into the comment section of the video so that you can sign up. And subscribe to the YouTube channel so that you don't miss any future updates. We'll have another ChartStorm run through on Sunday, and then yeah, we'll just leave it to you guys. If you have any requests for me to cover something, then by all means let me know.